Shop at ageofthestoner.com.
How institutions quietly control market direction. Most people believe markets move because of headlines. They think a news event, a tweet, or an earnings report is what pushes prices up or down. That's not how it works at scale. Markets move because of capital flow, and institutions control capital flow. Institutions are pension funds, hedge funds, sovereign wealth funds, insurance companies, mutual funds, asset managers, and central banks. These entities control trillions of dollars. Retail investors control a fraction of that. When trillions shift allocation, direction shifts. It's not loud, it's not dramatic, it's structural. Institutions don't trade like retail. They don't wake up and buy based on emotions. They allocate capital based on models, mandates, and risk frameworks. Every large fund operates under asset allocation rules. For example, a pension fund might run 60% equities, 30% fixed income, and 10% alternatives. If equities outperform and rise to 65% of the portfolio, the fund is required to rebalance. That means selling stocks and buying bonds. That single rebalance can move markets. Multiply that by hundreds of institutions doing the same thing at a quarter end. That's why you see systemic flows around certain dates. This isn't conspiracy, it's mechanical. Institutions also move markets through liquidity management. Liquidity is the ability to buy or sell without dramatically moving price. When liquidity is high, markets move smoothly. When liquidity is thin, small imbalances cause volatility. Large institutions know where liquidity sits. They understand where stop losses cluster, where options expire, where volume accumulated. When price approaches those zones, liquidity events happen. That's what many retail traders call fake breakouts or sudden reversals. It's not random. It's liquidity being accessed. Institutions also use derivatives to influence positioning. Options markets, futures markets, and swaps create hedging flows. When options dealers hedge exposure, they must buy or sell the underlying asset. That creates directional pressure. If large amounts of call options are purchased, dealers hedge by buying underlying assets. That buying can push prices higher. When puts dominate, hedging can push price lower. This is called gamma exposure. Most retail traders never look at it, but institutions do. Another mechanism is passive flows. Index funds and ETFs allocate automatically. When money flows into index funds, they buy all components proportionally. That means capital flows into the largest companies automatically. That's one reason mega cap stocks dominate market direction. Passive inflows create structural buying pressure. Now think bigger. Central banks influence market direction through liquidity conditions. When rates are low and liquidity is abundant, institutions increase risk. When rates rise and liquidity tightens, institutions reduce risk exposure. This isn't emotional. It's risk-adjusted return management. If bond yields rise, The attractiveness of equities decrease relative to fixed income. That shifts allocation. That shift moves markets quietly over months. Institutions also control direction through credit markets. Credit spreads widening often precede equity declines. Institutions watch credit stress before retail sees price drop in stocks. When credit tightens, risk appetite drops. That changes allocation. Another factor is systematic funds. There are funds that trade purely based on volatility signals and trend models. If volatility increases beyond a threshold, they reduce exposure automatically. If trends strengthen, they increase exposure. This creates momentum. When trends accelerate, systematic funds amplify the move. Retail sees a breakout. Institutions see signal confirmation. Now, let's talk about earnings season. Retail listens to earning calls. Institutions already modeled expectations months prior to that. When earnings hit, the reaction is often based on positioning, not numbers. If institutions are overweight and results are merely good, price may drop because positioning was crowded. Direction isn't about good or bad. It's about positioning versus expectation. Now, consider pension contributions and retirement flows. Every month, retirement accounts receive inflows. Those inflows go into equities and bonds automatically. That steady stream creates structural demand. Over long periods, this steady capital inflow supports asset prices. Institutions also influence markets through capital rotation. Money rotates between sectors based on macro themes. If institutions expect inflation, capital rotates into energy and commodities. If they expect slowing growth, capital rotates into defensive sectors. Retail sees sector movement. Institutions move capital deliberately. Even geopolitical risk is processed institutionally. When risk rises, funds increase cash, gold, or defensive assets. They don't panic. They shift exposure based on probability models. Markets look chaotic day to day, but beneath that noise, capital is reallocating quietly. Another layer is liquidity provision. Market makers provide bids and offers. When volatility increases, spreads widen. That affects execution costs and can accelerate moves. Institutions understand liquidity debt. They break large orders into smaller ones to avoid slippage. They use algorithms to execute over time. That's why you rarely see massive single prints from institutions. It's quiet distribution or accumulation. When you see long consolidation ranges, that's often institutional positioning. Retail gets bored. Institutions build positions. Then breakout happens. Retail thinks it's sudden, but it was prepared. The market is not controlled by one entity. It's influenced by coordinated behavior driven by similar models and constraints. When large players follow similar risk frameworks, their actions align. That alignment moves direction. Understanding this changes how you view markets. You stop reacting to headlines. You start watching capital flow. You pay attention to volume at key levels. You notice how price behaves around liquidity zones. You observe how markets respond to macro shifts in rates and liquidity. Markets are not emotional. Participants are. Institutions remove emotions. They manage exposure. They rebalance. They hedge. They allocate. And when trillions shift allocation, direction follows. If you want to understand market direction, don't ask what happened today. Ask where capital is flowing in. Ask how liquidity conditions are changing. Ask what risk models are forcing funds to do. Because quietly, beneath every candle on the chart, capital is moving. And institutions control capital. That's how market direction is shaped. Not loudly, but structurally.